All right, let's get right into it. The big question on pretty much everyone's mind is when inflation will finally get back to normal. We've definitely seen some progress, but a lot of economists are looking ahead to 2026, and, well, the picture is a bit more complicated than any of us hoped. So let's dive into why that is.
So here's the deal. We all feel it, right? At the grocery store, at the gas pump, everywhere. Prices shot up like a rocket, but they seem to be coming down at a snail's pace. It is the #1 economic puzzle right now, and today we're going to break down exactly why progress seems to have hit a wall.
And this chart really shows you the core of the problem. The Federal Reserve has a crystal clear target, a 2.0% inflation rate. That's the goal line. But look at the forecast for 2026. It's showing inflation settling in a range of 2.4 to 2.7%. Now sure, that's way better than the peaks we saw, but it's still stubbornly above that target. And that gap, that little bit extra, that's what we're going to unpack today.
To get to the bottom of this, we're going to walk through 4 key parts. First, we'll lay out this inflation puzzle. Then, we'll unpack 3 big forces that are keeping prices sticky. After that, we'll look at the possible scenarios for 2026. And finally, I'll give you a quick watch list so you can track all this stuff yourself.
Okay, so let's start with the puzzle itself. Think of it like a marathon. We ran most of the race pretty fast, getting inflation down from those crazy highs in 2022. But this last leg of the journey, getting from around 3% all the way down to 2%, is proving to be the hardest part by far. The momentum has really slowed down, and that leaves us in this tricky, in-between spot.
So what's actually causing this stickiness? What's the holdup? Well, it's not just one thing. It's actually a combination of 3 really powerful economic forces that are all pushing and pulling on prices in different and sometimes surprising ways. The 3 forces we're going to dig into are, first, the impact of tariffs and trade policy. Second, something we're all familiar with, the constant volatility in energy and commodity prices. And third, and this one is really fascinating, the kind of paradoxical effects of artificial intelligence and productivity.
Okay, first up, tariffs. This is a pretty straightforward supply-side issue. When the government slaps new or higher taxes on goods we import, it just makes those things more expensive. So businesses that rely on those parts or products suddenly have to pay more. And guess what? They almost always pass that extra cost directly onto us, the consumers.
And this isn't a small potatoes issue. Economists estimate that a broad rollout of new tariffs could add anywhere from 0.5 percentage point to a full 1.5 percentage points to the inflation rate. I mean, think about that. That move alone could be enough to keep inflation well above the Fed's 2% target. The second force is one we all know well, energy costs. You know, geopolitical tensions flare up somewhere or supply chains get disrupted, and boom, the price of oil spikes. And because energy is a key ingredient in almost everything, from shipping food across the country to manufacturing goods, even small increases in energy costs have this huge ripple effect throughout the entire economy, helping to keep inflation sticky.
All right, now for our third force, and this one is a genuine head-scratcher, the AI paradox. We hear constantly about how AI is going to make everything cheaper, faster, more efficient. And you know what? In the long run, that's probably true. But what's happening right now is a completely different story, and it's actually pushing prices up. Let me break it down. In the short term, you've got companies spending billions upon billions on the raw materials of AI. We're talking data centers, high-end computer chips, and just massive amounts of energy infrastructure to power it all. That huge investment boom creates a ton of demand and drives up costs. It's only in the long term, once all that stuff is built and AI starts delivering those promised productivity gains, that we might see savings passed on as lower prices. For 2026, we're almost certainly still going to be in that inflationary investment phase. Okay, so you've got these 3 powerful forces swirling around: tariffs, energy, and AI. So what does the future actually look like? Well, nobody has a perfect crystal ball, but we can map out a few really plausible scenarios for where inflation might end up in 2026. So let's look at 3 possibilities. In the best-case optimistic scenario, those AI productivity gains show up faster than we think and trade tensions ease off. That could get inflation down toward 2.2%. Then there's the downside risk. We get hit with major new tariffs, or there's a big energy price shock, and that could push inflation way up, over 3.5%. But the most likely path seems to be this base case, right in the middle. Here, those supply shocks from energy and tariffs just kind of stick around, AI's effects are still moderate, and inflation just hovers in that frustrating 2.5% to 3.0% range for most of the year.
So the real takeaway here is that a quick, easy return to that 2% inflation target just isn't very likely. The balanced view suggests that while the trend is still pointed down, these powerful forces we've talked about will probably keep inflation stubbornly above that target for most of 2026. And that has huge implications for everything from interest rates to our household budgets.
So how can you follow this story as it develops? Because this isn't just for economists to worry about. There are a few key signals you can actually watch yourself to see which one of these scenarios is playing out in real time. So here's your watch list. First, keep an eye on those monthly inflation reports, specifically the core PCE and CPI numbers. If you see those numbers getting stuck above 2.7% month after month, that's a real warning sign. Second, watch the news for any hard details on new tariffs and how they're actually being put into practice. And third, track energy prices and look for data on capital spending related to AI. These three signals will give you a pretty good idea of where we're headed.
You know, at the end of the day, this isn't just some abstract economic debate. The outcome of this inflation battle directly hits your wallet. It affects the purchasing power of your money, the interest rates you pay on your mortgage or car loan, the returns on your savings, your entire cost of living. Understanding these forces is absolutely key to navigating your own finances.
And that really leaves us with the ultimate question for 2026, doesn't it? Will the deflationary power of new technology, like AI, win the day? Or will the inflationary pressures from things like tariffs and energy shocks keep prices uncomfortably high? The answer to that is going to define our economic landscape for years to come.
I hope you liked this video. Don't forget to like and subscribe.